Okay, good morning, guys. Welcome to the next webinar here. Today we're basically going to talk about how to become the 10%, okay? We realize that there is, in this emotional market cycle that's happening, most people are making wrong decisions, okay? And, before I even started being profitable in trading, I was one of those 90% of people as well. So, and I'm pretty sure everybody experiences this where trading just isn't working out for you and you're losing more than you're gaining, and, you kind of give up. And, honestly, I quit trading 2 times for sure. And one time where I was really on the fence about it. I lost so much I had to basically build up my confidence to trade again. So today we're going to talk about how to become the 10% and how to understand loss and to deal with it, okay? Because we're all going to deal with loss, even when you start the game, you're going to have times that you're going to lose. I lost a little bit on a Bitcoin trade yesterday, gotten stopped out, got into the market a little too early. It happens. So, but how we deal with that emotionally is what separates us from the other 90%, okay? We're going to have losing trades, okay? It's definitely going to happen. But we don't want to continually have losing trades, okay? We don't want to get caught up in these emotions and chase things when we shouldn't be chasing them, or being impatient and getting into a trade at the wrong time, or being patient at the wrong time and holding on to a trade when we shouldn't. Okay, these are the biggest things that lead to loss. Okay, number one really that I found leads to loss is impatience. Okay, impatience meaning that when you see a market moving, you get into it at the wrong time. Okay, like for instance, when we look at Ethereum here, after we broke out from this right here, okay, the market's set up so that anybody who bought this break right here, if you don't take profit, you're going to get liquidated. You're going to be at a negative loss. So you always have to remember to take profit when it's there and be very patient on your entries. Okay, be very patient with your entries, and if the trade's not going the way that it should, cut your losses short. Simple as that. So we're going to talk a little bit more about how we can kind of spot these things as they're coming and make sure that we don't get caught up on the wrong side of the trade. So first, by identifying the market cycle, like we talked about on Monday, we can kind of clarify which side of the market we should be buying and which side of the market we should be selling, okay? Then we get into using Elliott wave theory. We can kind of have a little bit of a basic idea of when would be the time, okay? This is why I practice Elliott wave theory, because it kind of zones in on the prime opportunities to trade when other people are losing, okay? For instance, in this Elliott wave impulsive cycle here, all right, there's 3 basic rules that Elliott waves follow, okay? Meaning that this first impulsive wave cannot come 100%. It has to basically hold a good retracement, all right? And that number 2 is that prime spot for my entry, for my technique that I use. Because when you have an impulsive move like this, anybody that chases it on the way up is going to get washed out on the retracement. And this is basically after you have a bullish move and everybody chases it too far, then when the price starts to come down, a lot of people will realize that they bought too early, and they'll start to sell at a loss. If it's on margin or on leverage trading, they'll get liquidated if they bought too soon here. And so that's why I always say don't chase it. Wait for the retracement of it. Okay. So that's the first one there. Like, I don't ever chase the breakout. Okay. I don't ever chase the breakout. When things break out, I watch them break out. I see where they stopped. I put a Fibonacci ratio on the actual move to measure it, and then I get it on the retracement. And most of the time when you're talking about a new impulsive cycle that is beginning, most of the time this retracement here is when everybody realizes that they bought too late, and they're kind of getting flushed out. That's when people are really don't want it, but we want to come in and we want to buy that retracement, especially if it's a new impulsive move after accumulation. and we see a nice pop in the market like this, that's the number one thing, is to train yourself. Train yourself when you're seeing the market move. Don't chase it. Literally, do not chase it. Let the market do what it's going to do and sit back and be patient. Because almost every single time that the market breaks out like that, people chase it too far, it gets overextended in price, and then it comes crashing back down to about 50 to 61%. That's where we want to wait. We want to wait and get our placement at that point, okay? So we want to basically watch these moves unfold and realize how other people are going to lose on them. As simple as that, you know, like here's a prime example here of a move that we played in XEM, okay? Now, here, please bear with me, guys. My trading view has been very laggy the last 2 days. I'm not sure. Other people tell me theirs is kind of laggy too, so I'm not sure exactly what's going on. But it's taken me a couple clicks to get things going here. So here, on XEM, we had a breakout move here, okay? We had a nice 1 and a nice 2. All right. Now, right here, we had another move in the market. All right. And when the price came back down, this is where we entered. All right. On that one signal that I sent a couple weeks ago. I'm going to show you guys why and how this. Oops, I'm getting another fib there. Okay. Playing this strategy, this Elliott wave strategy, and understanding the basic rules of the Elliott wave formation, you got to basically know what you're expecting and to expect other people to lose money on these moves. Okay, and here's a perfectly good example. Like when the price breaks out, anybody who chases it on this leg up is going to be sitting at a loss on this leg down. So if you don't buy the number 2 retracement, you chased it and you're questionable in your trade. The only real secure people in this trade are going to be the people who bought the retracement. Bought the retracement kind of knowing, with my Elliott wave strategy, I always look for the number 2 points. In impulsive bullish markets, I always look for number 2. If I can't get on number 2, I go for number 4. I will never buy this impulsive leg up because I always expect it to retrace. I will never buy this third impulsive leg up because it's set up to also liquidate people who chase it. Okay, like most of the time when the price is going up on a market, if I see that the price is going up on something, I won't buy it when the price is going up. I'll buy it when the price is coming down. Because anybody who's buying and making these candles green is most likely chasing the price or chasing it out of a breakout pattern. And then when it comes and does the retracement, you know, everybody kind of gets shook, they get scared, they sell it down, and maybe even sell it at a loss. That's when we wait, because we've already identified the market cycle, the trend, the overall new cycle that's beginning in a lot of these, you know, clearing a resistance. You know, we've already mapped out what should be coming, you know, like the change in the trend and the new impulsive movement in the market. We've already mapped that out. So we're expecting stuff like this. We're expecting the market to say, okay, you know, we broke a resistance, we cleared a cloud or some sort of a level, and we're creating a new impulsive cycle. Off of that impulsive cycle, you're going to get everybody that's going to chase it. And then you want to get that retracement, okay? Right there, get that retracement. If you can't get that one, then wait, get this number 4 one. Okay, because if you buy this third leg, and this is how the market also liquidates people, especially breakout traders. Okay, like there's nothing wrong with trading breakouts, but it'll only get you so far for so long if you don't understand the Elliott wave theory behind it. Okay, meaning that, for instance, with a move like this, okay, now this right here had a nice breakout move right here. Okay, but anybody who chased this thing on its way up kind of shook out right here, or at least questioned their trade when it came down here to this low. Okay, now on all these moves, you'll always want to see, you know, just when you see a breakout, don't chase it, guys. Just wait for it to do its retracement right in there. Bam. That 50% mark, that's the prime spot. You know, I will be waiting here between 50 and 61%, where I see the number 2 here. That's this is where I want to get in. I don't want to chase the breakout, because everybody who chases the breakout, they're going to lose money on the retracement. Okay, that's the prime spot. That number 2 is the prime entry spot. Okay, let's get this out there. Now, what happens is if you're not paying attention to Elliott wave theory and you're just being, let's say, a breakout trader, and you're trading the breakouts with the momentum. So a lot of people are looking at this like this, like when this thing breaks right here and creates this little cup and handle, you're going to have a lot of people that are going to chase it when it breaks right here. Okay. A lot of people, they're going to chase it once it breaks this line. All right. So breakout trading is fine. You could chase this breakout and get this little impulsive move, but you have to be aware of your Elliott wave count. Okay. So this is where breakout traders are going to lose, because after this impulsive wave 3, wave 4 is going to come crashing down. Okay. Wave 4 is going to come crashing down. And most of the time, it's going to challenge the height of wave 1. Okay. But there are specific rules with Elliott waves. Wave 4 should not overlap with wave 1. Okay. And sometimes we see it where it respects it and it comes down, like relatively close. And other times we see it where it comes crashing right down into the wave. All right. Especially in cryptocurrency, there's a lot of panic and people really don't know what they're doing with trading. So this is a really juicy spot to get it right here, because this is an overextension of sell off here. Everybody who bought the break here is now losing money on the way down, and they're getting liquidated. Now, this is the prime spot to get into this trade here, off of the fact that you understand that your Elliott wave 4 should not really overlap Elliott wave 1. Now, here we have an example where it kind of crashes into the wave. Pull this Elliott out of there for a second. Okay, kind of crashes into the wave here. But if you really consult your open and close for that time period, it hardly really even, it came in, it bounced off of here. Come on, too many lines. Okay. It came down and it bounced off of here. It tested this zone, okay, but it rallied back out. All right, even though we had expansions in price below this line, the line chart does not tell us the expansions in price with the candles, okay? The candles are always going to show us the wicks and the expansions in price. The line chart is always going to show us the open and close for that time period. So I refer to the line chart if I'm trying to get into a trade and I'm saying, okay, this thing is going to be selling down. People are going to be losing money on this right about here. This would be my number 4 point in my wave count. I'm expecting this thing to turn around relatively in this area. All right, relatively in this zone is where I'm expecting this thing to turn around and expect to get into my buys right here with the respect of this wave height. And I refer to the line chart, every now and then to kind of, see where I might be getting expansions in price beyond the open and close price there. So here, you don't want to buy the break, you want to buy the retracement. Everybody who buys the break, unless you bought it down here, right on the break, you chase it anywhere in here, past this point, you're basically coming down here at break even. You didn't make any money on the trade. And, when people jump into a trade with the momentum and they don't make money on the trade, they'll either cut their losses short or, maybe just break even right there and not realize that that's the actual prime entry point right there, is that number 2 point. All right. Number 2 is the safest, because even when wave 4 comes back down, you're still in profit, still in profit, getting ready for that next setup move. So it depends. Sometimes I play these waves where I'll get in on a number 2 point and try to sell at a number 3 point and maybe come back in a number 4. Or, if it's something I see has greater potential, I'll try to get in here and then just kind of basically hold my position, and as we move up in price, I will start to move my stop loss to lock in some profit. So those are the kind of things that we're looking for in the trades, to where other people are losing money by chasing price and we're waiting for it. We're understanding the direction that this thing is going in, and we don't want to chase it. We want to get on the retracements, whether it's the number 2 or the number 4, because with Elliott wave rules, number 3 wave, it should not be the shortest. Okay, it doesn't mean it has to be the longest, but what I found is that most of the time, number 3 expands in price. It expands in price so that when it comes back down with that number 4, you're still making progress. So one little way that I always look at the market is that I say, all right, if I had an impulsive wave, here, that went from here to here, and now I'm expecting that thing to have a retracement, and we see it had a 50% retracement that came to about here. This next wave, this 3, I'm expecting that to at least be the length of wave 1, at least, because if wave 3 can't be the shortest, the chances of it being shorter in wave 1 are very slim, okay? And it has to be that expansion wave that at least goes at least the length of wave 1, if not a little bit further. I think this one's a little bit further, so that its retracement is still making progress. You know, like we're climbing stairs here. You know, we went up, we came back down. We went up again, we came back down, but we respected this level in price. That has become support now. And then we continue on. And I have found in cryptocurrency that this 5th wave is always seems to be the longest. You know, this nice Elliott wave formation that we get right here that you see, this is pretty common in cryptocurrency because you have a lot of that fear of missing out. Like once it holds support here and it starts to rally again, then you get, you know, this whole cup and handle again, breakout scenario right in here that all the breakout traders are going to chase once it breaks right here. Okay, which is why you see this influx of volume right here. Okay, this is all the retail traders that say, oh, man, this thing's still moving, it's still going. And then that whole fear of missing out kicks in, and that 5th wave pushes us a little bit higher. So we just got to be in tune to how the market is unfolding in waves and capitalize on it. I mean, simple as that. Like, you know, we want to look for places that other people are going to lose money in this impulsive wave set here. So first and foremost, this is an emotional game, okay? This is an emotional game where we want to really be in tune with our emotions and have a very detailed strategy on our trades. We don't want to enter trades randomly. We don't want to enter trades based on a gut feeling or